Welcome back to Thoughts on Investing. If you were watching the stock market between April 6th and April 12th, 2026, you probably noticed something strange. The market didn't crash and it didn't rally. It just froze. Today, we're going to diagnose exactly why that happened. Before we break down the data, a quick reminder, everything in this video is for educational purposes only and is not financial advice. Always do your own research before investing. To see what this freeze actually looks like, take a look at this chart showing the major indices. We have the Dow, the S&P 500, and the Nasdaq. Over the course of the week, the trajectories are almost completely flat. We're looking at microscopic gains and losses across the board. For institutional traders, a chart that looks like this is a specific signal. It tells them the market has entered a deliberate pause. The money managers aren't panic selling, but they aren't buying either. They've placed themselves in a neutral holding pattern. This happens when massive macroeconomic forces push against each other. Investors become paralyzed. They choose to sit on their cash, refusing to deploy new capital until a clear, definitive economic signal tells them which way the wind is actually blowing. The first major force keeping the market pinned down is the energy sector. We're seeing intense volatility in the global supply chain. And interestingly, this is happening even as the intensity of certain international conflicts begins to cool off. Energy markets are highly reactive right now. The supply chain is so tightly wound that a minor update about international shipping routes or a single stalled political talk is enough to instantly send the price per barrel shooting upward. In Washington, President Donald Trump has signaled a direct policy shift. His administration is now making global economic stability a top priority, putting political weight behind keeping oil flowing smoothly through international markets. Traders generally like to hear that kind of assurance. But right now, the underlying fear of a sudden supply disruption is still outweighing those political promises. The optimism is not strong enough to break the stalemate and trigger a full market rally. The second force freezing the market is a direct result of those oil prices. When energy costs become unpredictable, that instability breeds straight into the baseline operating expenses of virtually every industry. As companies absorb higher costs for transport and power, those expenses eventually reach the consumer. This keeps inflation figures high across the board, creating the exact kind of economic pressure that keeps the broader market on edge. The institution tasked with fighting that inflation is the Federal Reserve. They have the power to control borrowing costs across the entire economy by setting baseline interest rates. When inflation stubbornly refuses to drop, the Fed adopts a strategy known as higher for longer. This means keeping interest rates elevated for an extended period. High rates make borrowing money expensive, which heavily restricts corporate expansion and punishes any company carrying a lot of debt.
This leaves the market trapped in a paradox. If the economy shows robust consumer demand, traders actually get nervous. They worry that strong demand will force the Fed to keep borrowing costs high, prompting investors to pull their money out. The third force is an extreme performance gap dividing different industries. This gap is dictated entirely by how well a specific sector handles those inflation pressures and fuel costs. On one side, you have the clear winners. Energy companies are operating in an environment of high demand and elevated oil prices, allowing them to log massive profits while the rest of the market stalls. The secondary winner is the US dollar. In periods of high global uncertainty, international investors treat the dollar as a safe haven asset, buying it up as a reliable hedge against local inflation and instability. On the exact opposite side are the losers. The airline industry is taking a direct hit right now, actively bleeding capital because of the immense cost of jet fuel needed to keep their fleets in the air. The broader transportation sector is facing the exact same problem. They are being squeezed by a brutal combination of high fuel expenses and a hesitant, uncertain public that is reducing its global travel demand. Then you have the undecided category, the technology sector. Tech is flashing highly inconsistent signals, showing a mix of gains and losses week over week. Traders aren't betting on tech as a whole right now. Instead, they are being extremely surgical. They are avoiding broad tech portfolios and aggressively funneling their money into specific AI and semiconductor firms that promise long-term growth. This extreme sector divide shows that capital hasn't left the market, it's just migrating. Investors are retreating from immediate risk and parking their cash in safe haven assets while they wait for the outlook to stabilize. Zooming out, Wall Street is not alone. This exact same sideways freeze is currently paralyzing stock exchanges across the globe. Regional performance is largely tracking with energy dependency.
Nations that export fuel are seeing their markets bolstered by high prices, while energy importing economies struggle to absorb the rising cost of keeping their industries running. To break this global stalemate, traders are waiting for one of three specific catalysts. They urgently need a definitive interest rate cut from the Federal Reserve, a clear stabilization in the oil supply, or a major and lasting geopolitical truce. For retail investors, the takeaway is straightforward. Until one of those three catalysts actually happens, the smartest move is patience. Maintain your caution and carefully resist the urge to force a trade when the market itself is choosing to wait. I want to hear your take on this. Where do you think the market is headed next? Drop your thoughts in the comments below. If you found this breakdown helpful, hit the like button and make sure to subscribe for our weekly market recaps. Thanks for watching, and I'll see you in the next one.